Technical factor number 5, new issues.
New stocks are issued all the time, sometimes because companies are going public, sometimes because old companies need to raise more money, and how willingly the investing public buys up these stocks is a very important market sign. Now, generally speaking, during a bull market, new issues are hot. People talk about, hey, did you hear about this new stock or whatever? They all want to buy one. They roll out in big numbers, and they get grabbed up quickly by investors because it seems during bull markets that the public's appetite for new issues is limitless. And, of course, the more they buy, the companies are perfectly willing to sell them more. Eventually, however, it does get a little backed up. The public just can't take any more new issues. When the new issues market gets sluggish, prices for them won't go any higher. Even though the market is headed up generally, when this happens, watch out. This is a danger sign. It could mean that the market as a whole is about to run out of steam. So when you see prices for these new issues going down, with this oversupply, they easily could, it could carry over into the rest of the market. At the very least, this means that the public has lost its taste for speculation. Now, you can keep track of new issues in the financial pages of your newspaper. When you combine all of these technical factors, stock averages, volume, breadth, major stock groups, and new issues, this will help you look inside the stock market. You get a sense of the forces at work at its core, and that should provide you with valuable information to make your own investment decisions. But remember, they work best when you use them together over a period of time. Each by itself can be misleading.
Thanks for listening to All Stock Radio. Coming up next, segment 6, charts.
Breadth is the total number of shares of stock traded one day on one particular exchange. True or false? False. Breadth is the total number of different companies' stocks that were traded, not the total number of shares. Volume alone is not a very useful indicator. What else do you need to know? You need to know prices and recent trends in the market. You should always use them to help you evaluate volume. Which of the following is not a technical factor? A, volume. B, breadth. C, money supply. D, new issues. The answer is C, the money supply. This is a fundamental indicator. To find out more about it, go back to segment 4.
Now we come to stock charts. This is yet another tool for market analysis. There are people who go crazy over stock charts. They think that they can learn everything there is to know about a stock by charting its price. Well, before I show you how to do that, I first should tell you that we don't agree. We think you should use all the analytical tools we've talked about, fundamentals, technicals, and then stock charts. What stock charts can do for you is give you a quick, at-a-glance history of a stock's price, and you will see that that can reveal some important patterns. But first, I want to show you a list of stock prices, much like you'd find in your daily newspaper. These are prices from the New York Stock Exchange, and if you look over here, you'll recognize the familiar name of our favorite company, the Stretch Rubber Band Company, abbreviated here simply as Stretch. Now, as you can see, on either side of the stock's name, you will find a set of numbers, and some of you, anyway, have wondered what all these numbers mean. Let's take them one at a time. On the left side are the stock's high and low price during the previous 52 weeks. Moving to the other side of Stretch, we get the dividend, if there's been any declared recently, then the yield on the stock at today's price, and then here, number 10 is the current price-earnings ratio, and then the number of shares in hundreds that changed hands yesterday. The number 72 means here that yesterday 7,200 shares of Stretch were traded. Now, we come to the three numbers that you use to create the stock chart. These three columns here give you yesterday's high price, yesterday's low price, and the price that the stock closed at. These are the numbers for Stretch Rubber Band yesterday, and the column right here next to me tells me the difference between yesterday's closing price and the day before's. You've had a nice day here, up 3/4. Now what we are going to do is change this information to this kind of information, and here is how. Each bar in this chart represents 1 day of trading of the Stretch Rubber Band Company. Let's just choose a bar, this nice long one here. Now the high point of the bar marks the day's high, the low point the day's low, and that little cross mark right here in the middle shows you where the stock closed. Now if you chart your stocks like this, day after day, you will end up with a graph very similar to ours. You can also chart the day's volume for a stock day by day. We've done that down at the bottom of the graph, so that at a glance on any day you can say, on this day volume was, and the stock price, however, did pretty well. It's a kind of x-ray of your stock's health. Now don't overrate what you can learn from one of these charts, but there are important lessons to be learned from the patterns that emerge. Most stock charts do look like this. They've got some highs, some lows, but the rises and the drops stay within certain limits. Often the stock will rise up to a certain point, but not higher. You don't see any booms here. Or it'll fall to a certain point, but not much lower. It's almost as if the stock's price was bounded by a ceiling and a floor. And the fact is that the prices of many stocks act like this. And the ceilings and floors are most apparent when you chart your stocks. Now there are clear reasons for those ceilings and floors. So let me start by demonstrating a floor. This is my price level. Let us say that the stock's price starts to fall to a certain point. And this happens again and again. At some point, the stock just stops falling. It just won't go any lower. The stock has hit a kind of floor, and that is because at this low price, it's gotten attractive to investors. They start buying it up, and that keeps the price from dropping any lower. Technicians call this floor a stock's support level. If the chart shows that this same support level has existed over a period of years, that's a good sign, because you can have some confidence that the stock probably won't drop in price below that level. So if the stock is currently at the floor or near the floor, you might consider buying it because the guess is it's not going to drop much lower. Now let's take a look at a ceiling. Say that the price is starting to rise. Now there is a point, and it happens over and over and over again, where it just won't go any higher. The stock owners think that this stock isn't worth more than this level, and they feel the price is going as high as it's going to go, so at this level they decide to bail out and sell, which keeps things from going any higher. Technicians call this ceiling a stock's resistance level. And if you find that the stock you want is hovering up there around that resistance level, then you better think twice about buying it, because at that point it could come down again, probably will, and down below it'll be a much better buy. Now, sometimes the stock market runs into a period of relative inactivity where stocks don't go up very much, they don't go down very much, they just kind of move along in a regular rhythm, kind of sideways. In fact, that's just what technicians call this, a sideways market. And they also call it a trader's market because only those who love to trade frequently and gather up small amounts of profit can make money in this kind of a market. But if you get impatient and you're thinking, well, come on now, I want to do some trading, like a bull market, like a bear market, this sideways market won't last forever. Our suggestion is, wait it out. Be patient. Wait till either you see bullish forces or bearish forces gather strength, and then make your decisions.